God help us, the war has been surrendered. Martin North, John Adams, in the interest of the people. John, hello, welcome back. Another quick update because there's so much going on.
Absolutely. What I find very interesting, Martin, is that we've been talking in our last few shows about, in terms of this big choice that central banks have to make between inflation and deflation. And ultimately, I am of the view that they will surrender to inflation. But what I am staggered by is how quickly they've all capitulated. So even from our last show, so we're recording here on Sunday morning in terms of New South Wales time, and the more central banks have conceded the fight to inflation. Now, they haven't done it through their actions yet, but they've done it largely through their words. And you know, ultimately, when push comes to shove, that the war on inflation has been lost. And this has huge implications for our viewers and for you and I and the world at large. And so today we're going to give our viewers another quick update as to what's happened in the last 3 days and why it's significant to understand in terms of where the economy is at today, but also as we go forward.
Well, there's a little phrase from the world of banking where words and figures differ. They used to refer that for checks, right, where you used to write out in words the name on the size of the money on the check, and then also put the figures, and sometimes they differ. That's what I feel about central banks at the moment. They're sort of saying one thing over here, but actually over there things are a bit different, right? And this is really the heart of the problem, isn't it? That effectively you've got inflation over there, you've got liquidity problems over there, and all the other issues, and they're stuck.
Exactly. Now, 2 shows ago, we talked about inflation risk, liquidity risk, and credit risk. So let's just put that slide back up on the screen. Now, we're not going to go back and explain those concepts again. So I think you said off camera, Martin, that some of our audience may not fully understand what liquidity risk means.
Yep.
If anyone's slightly confused by what we mean by these terms, it's easy. Just go on Google and just type in liquidity risk, credit risk, inflation risk, and you'll get some more detailed information about that. But it's critical that our viewers understand about what these concepts mean, because these concepts are really driving the decision-making framework for central banks.
Now, just very quickly, liquidity basically means can you buy and sell what you want to do when you want to do it, right? And when liquidity dries up, it means that sometimes you have problems in trying to actually buy or sell whatever it is, right? And you can have liquidity in lots of different markets. And it's a very important sign, like the number of bonds being issued has come down, liquidity in other markets are also frozen out at the moment. So liquidity and the liquidity risk was actually what triggered the 2008 global financial crisis.
Exactly. Now, one of the really interesting aspects of this, Martin, is that how quickly events are moving, and so there is a famous investor fund manager from the United States called Carl Bass, and so let's actually put slide 2 on the screen, because he actually goes into detail as to why things are moving so rapidly. So he says there have been 7 disinflationary periods since the creature from Jekyll Island first hatch, i.e. the US Federal Reserve. All 7 have included recessions, and this one will be no different. Financial conditions are tightening at lightning speed. Over 33 trillion of equity declines, 2 trillion of crypto losses, largest bond market losses in history, and Fed balance sheet withdrawal of almost 100 billion of risk assets each month, just beginning. University of Michigan consumer confidence at 70 years low. Hard landing is assured. Now, so we'll get into the question of hard landing, soft landing, because I think there's a lot of false hope being projected even in the Australian media. Absolutely. In terms of a soft landing. But obviously the speed of these losses and obviously again, why are these losses happening so quickly? It's because we've got the biggest bubble ever. And these markets have been manipulated to such an extreme level that once you just take your foot off the accelerator just a touch, they quickly unravel very, very, very quickly. And the pace in which these moving in the last, say, 3-4 weeks is probably the fastest we've ever seen in economic history.
So if you think about quantitative tightening, they really haven't started yet. it's just beginning to sort of tick over, and already we're seeing this liquidity problem.
Yes. Now, I just want to spend a couple of minutes about the cryptocurrency market, because we are really seeing this issue of liquidity and credit risks really blowing up there. And so a lot of investors across the world are experiencing major losses. So
I'd say speculators rather than investors, but that's a...
Well, investors are speculators, but of all the asset classes that are out there, the one that is crashing the hardest, the fastest, is cryptocurrencies. Now, last episode we talked about Celsius Bank, that basically had a liquidity problem. They ran out of liquid cash to meet redemptions, and they self-imposed capital control. So let's put slide 3 on the screen, because we actually have another, in terms of crypto bank, called Babel Finance, and they basically again imposed capital controls on their operations, and they basically suspended withdrawals and redemptions because they're running out of cash. And so in this case, not as big as Celsius. So Celsius had about $12 billion worth of investor capital. Babel Finance has several $billion, but obviously those investors that have money tied up with this company basically have their funds stuck. And again, if they try to reopen Babel Finance, what's going to happen in the first 30 seconds is they're going to try to get their money out. And that's just going to crash it. And we'll get into a second as to the differences between the traditional banking system and these crypto banks, and what are the big differences. But so obviously Babel Finance has a liquidity problem, but the other interesting entity out of Singapore is a hedge fund called Three Arrows Capital, and they actually didn't have a liquidity problem; they had a credit problem. So they took various loans of Bitcoin from entities in the United States. And as Bitcoin has been falling, they had a margin call. So they were expected to stump up cash to meet their debt obligations, and they didn't have the money. So they basically they defaulted on that loan, and that's obviously caused huge problems in terms of this particular entity. And when you see a bubble, Martin, that has massive liquidity and credit problems, and they start to unravel, and whether it's the .com or in terms of subprime in 2008, these events feed on each other. Investors become very scared about the state of the market. People withdraw their money, and then it just becomes a negative feedback loop, and then these markets crash quite heavily. And that's why in the last 24 hours we've seen Bitcoin, which is obviously the number one cryptocurrency in the entire market, crashed below $19,000.
And just quickly, John, I made a show yesterday where I went through what's actually happening in crypto land, which is that a lot of those crypto investors or speculators, depending on which term you want to use, they're actually trying to force others to default. So they're looking through these various blockchains, looking for people in distress and then applying pressure. And actually, if they actually play it right, they can make money through those defaults. So if people want to know more about that, go and look at the Digital Finance Analytics post that I made yesterday. The point is, there are people now messing with these markets and eating each other in crypto land to try and survive.
Yes. The other really key aspect, Martin, is because crypto is an unregulated market with no prudential supervision, there are plenty of scams. And obviously, whether it's in terms of ASIC or the SEC, I mean, there's been regulators quite concerned about how retail investors are losing money. And so let's actually put slide 5 on the screen, because we actually have some commentary around. So this article comes from Zero Hedge, where they basically said that crypto investors have been lured in by frauds and scams via LinkedIn, and in some cases, people have lost, hundreds of thousands, if not more than, $1 million in putting their money into a particular venture in the crypto space, only to have their money stolen, and now they've been left high and dry.
Yeah, and again, John, it's worth highlighting. I think that if you follow some of the conversations, even on our channel, there are lots of people scamming Bitcoin schemes there. I try and knock them out as soon as I see them. But the point is, there will be people who actually have been just lured into this. And there is no regulation, there are no controls, but there are people who are very good at getting other people to do what they want, and it's a scam. And so people need to be very, very cautious, and particularly on social media and other places too, but also in buses. I was looking the other day at in London, for example, in New York, there are people advertising crypto schemes on the side of buses. Now that tells you it's just like the dot-com bubble all over again.
Yes. So one of the key points to make about the crypto market versus our traditional markets and our traditional banks. For example, Australia's banks are regulated by largely APRA. So they have rules about how they're supposed to conduct their business, but also they have rules about how much capital that they are supposed to hold. And there's obviously constant supervision by the regulator, and obviously we hope that supervision is robust. Although there have been questions about that. There has been questions about that, but there is an expectation that the government is checking the banks so that there is adequate capital reserves, so that if there is a run of some description, that the banks can meet those redemption requests, and that you don't have one or multiple banks falling over. But the crypto market is very similar to how banking was done in the 19th century, particularly in, say, the United States, where there was no supervision. It was the Wild West. And you had multiple, perhaps every sort of 7 to 9 years in the United States, multiple catastrophic banking failures because the banks lent out too much. People wanted to get their money. There was no money to be had. Rumors started circulating, a bank run, they would shut the doors, and then those banks would basically collapse. And to some extent, that happened in Melbourne in 1892 in the Depression. And for any of our viewers who have watched Mary Poppins, when Michael is in the bank with his sister and father, and he shouts out, "Give me my money back." Well, that rumor, listened to by the other depositors, causes mayhem within 2 minutes of the movie, and then basically the banks have to shut their doors because they don't have adequate liquidity to meet all the hundreds of depositors rushing into the bank saying, "Give me my money back. I've heard you've got a problem."
Yeah, and it's interesting, isn't it? In the middle of Mary Poppins, you have some wonderful economic discussion. It's very fascinating. But the point about crypto, of course, is that things can happen way more quickly because it's all digital, right?
Yes.
And there's no underlying asset at all. And as we've discussed on a previous show, crypto is really a religion. But if the religion actually starts looking at fragmenting, then it could disintegrate significantly.
Indeed. Well, I mean, look, without being too offensive to some of our crypto followers, perhaps some crypto investors are learning that there's no God behind the religion.
But I will make this point. There is still, of course, central bank digital currencies. This could really stoke the role of central bank digital currencies down the track, bring in interest rates going negative and a few other things too. So that's another thing just to keep an eye on later on.
Yes. So in terms of where I think the crypto market's going to go in is that particularly as central banks raise interest rates, and in the immediate term, when I'm saying in the next 90 days, I mean, there is still a commitment by, say, the RBA, the US Federal Reserve and other central banks to raise interest rates. Those raising of interest rates will dry liquidity out, and we will see more credit and liquidity failures in the crypto market. So that's why I think in the next 90 days we are going to see further falls in various prices of Bitcoin and the altcoins. And what I suspect is going to happen is you're going to have a full-on rout. And over the next couple of years, you're going to have perhaps some sort of industry consolidation. So I think a lot of these altcoins will go into the ether; they will disappear. And
unintended.
Obviously, in terms of Ethereum, but in terms of so just kind of like what happened with .com, a lot of companies failed. A lot of them went out of business. Some of them hung on. And some of them went on to grow into very large, successful companies. Now, I think the jury's still out as to whether Bitcoin will survive as a long-term function, and what Bitcoin will be in the next 5 to 10 years. But I think for those that have exposure to crypto, I think particularly the next 90 to 180 days will be extremely bad. And obviously, everyone needs to understand what risks they have, what they've exposed themselves to, and they've got to make their decisions accordingly.
And John, I say, and I've said before, I've always regarded the price of Bitcoin as completely unknowable, and therefore only invest in Bitcoin if you want to take speculation. You might win, you might lose, but you might well lose. The other point there, of course, is, and it's interesting listening to some of the people that I follow, and also some of the comments in the chat, people are still saying, oh, no, this is just another little blip, it's going to come back again. Just two other quick points. One is, of course, the cost of power is rising dramatically, and that means that Bitcoin mining is now getting to the point where it's not profitable.
Yes.
Right, which may actually turn off quite a lot of the creation of new Bitcoins. And the other is that many people have now seen their investment go into negative territory, and now they're trying to work out whether they should actually hold on the hope that it bounces back, or whether they should get out while they've got something. That's a real important point. And like I said, because it's digital, because you can actually transact immediately, you must expect lots of volatility and probably more risk the downside.
Indeed. Now let's switch the conversation to talk about central banks in terms of inflation. Now, before we get into some of the recent decisions that have happened over the last 3 days, it's critical that we highlight to our viewers a statistical trick that both the RBA and the Bank of England have expressly said that they're going to basically pull. And here's where there's going to be a miscommunication between what central banks are saying and what people on the street are actually experiencing in terms of daily economic life. And so let's put slide 7 on the screen. So there's a real difference, Martin, between price level and the rate of change. And so I've come up with a very stylized example. So just assume in year one, the price of petrol goes from $1.60 a litre to $2.20. In that change, we've seen price inflation of 37.5% in terms of the price increase. Now, assume in year two, the price goes from $2.20 to $2.25. Well, in year two, price inflation is only at 2.3%. Now, in previous shows, you and I have said, and perhaps I'm of the more stronger view, is that inflation is not rising prices. True inflation, if you go back to the pre-Keynes, so late 19th century, early 20th century definition, inflation is the increase in the money supply. The consequence of that is rising prices. But the way governments and central banks and statistical agencies measure inflation is they're measuring the rate of change of consumer prices. So what both Philip Lowe, when he gave an interview with the ABC 7:30 report, but also what the Bank of England said the other day in their official monetary policy statement, they said that if prices stabilize at elevated levels, that is sufficient to get inflation down. Now, so for example, in this example that we've just presented, so if prices stayed around $2.20, $2.25 a litre, that would be satisfactory for the RBA or any other central bank to meet their inflation objective. But that's completely different to whether people can actually afford to pay petrol at that elevated price. And so when you measure financial stress, mortgage stress, rental stress, you're not looking at the rate of change of price. You're looking at how much cash is the household obtaining and what price they are paying to meet all of their obligations, and is the cash sufficient to meet those obligations. So we could well see a situation where the price of petrol may stabilise at $2.20 in Australia. And I picked $2.20 because I just filled up my tank the other day, and I was roughly paying around $2.10, $2.15 a litre. So if in the next, say, 12 months, the price is stabilised at $2.20, now for a lot of households, that is going to be a massive financial impost, and that is going to entrench stress and cost of living pressures. But to the RBA, because the price is stabilised at a more elevated level, that to them is inflation under control. And so this is a really critical point, because no doubt your detractors like Kukulis will come back and say, well, inflation is under control, prices are stable, there's nothing to worry about in terms of the stress that households are facing. And obviously your claims of people being in financial trouble were overblown. Look, I think that criticism is coming. And so this is why I think we need to be calling this issue out of the rate of change of price versus price level.
No, I agree, John. And the point there is, I look at it on a cash flow basis. I always have done, always will, which is how much money is coming in, how much money is going out, how much latitude do people have. And it's interesting that there was some research done in the UK relating to household budgets there, and they highlighted the same problem, that the costs have got up and they stay up, right? So more people are getting into difficulty, and some people are having to pare back what they're buying in terms of food and missing out on meals and all those sorts of things. The real official number for inflation may not actually capture the true dynamics of real households.
Yes. So when people are watching the show and they're watching the mainstream media, they may hear over the next 12 to 18 months that inflation is under control. Now, if you hear that doesn't mean that prices have come down. That just means that prices are not growing to the extent that they were growing over the last, say, 6 months.
Yep.
And that's a very key difference in terms of what does that mean for your financial position.
Yeah, and it's the old base effect again, right? So you have a big rise, and then that works out, so it drops off a year later, and then suddenly it comes down again. But actually, the prices can still be very, very high. So actually, it's misleading.
Exactly. Okay, Martin, turning our attention to the Bank of England. So we recorded our last show on Thursday morning, and we foreshadowed that the Bank of England was going to make their monetary policy decision on Thursday night, Australian time. And so they came out with a 0.25% increase in their official interest rate. So they took it from 1% to 1.25%, even though they have current inflation in the UK at 9%. And if you read their monetary policy decision, they foreshadowed that by October 2022, UK inflation will get to 11%. So to my mind, what the Bank of England basically conceded is that they're not serious about fighting inflation. So we've obviously said in the past that to fight inflation, official interest rates must be above the inflation rate to have positive real interest rates. And so the English, your home mother country, have basically said that they're not up for the fight. And one of the key reasons why the UK is stuck, and they are stuck more so than other Western central banks, is that the UK has the weakest economic growth outlook of all the developed countries. So the UK economy is already struggling in terms of the ability for it to grow. They have a big debt overhang across the economy. Obviously, the UK, so the Bank of England balance sheet has been expanded quite a bit over the pandemic. And so if they were to aggressively tackle inflation like, say, the Americans, that would immediately push the UK economy into recession, and not just a shallow recession, it would be a very deep recession. And what they basically signaled on Thursday night was they're not willing to go forward with that type of policy.
But they are saying magically inflation will be down to 2% in 2024. How does that work?
Well, yes. So obviously in the last 12 months, the credibility of the Biden administration has collapsed because you had Janet Yellen and Jerome Powell saying that inflation would be temporary, would be transitory, and that hasn't happened. And so I think that the chickens will come home to roost for the Bank of England quite quickly. And also, let's just put slide 8 on the screen. So even writers in the British press, so this is an article from the UK Telegraph, and the article is, "We are stuck with a choice of brutal recession or runaway inflation." And so by the actions of the Bank of England on Thursday, I think they have selected for now runaway inflation, and they're not willing to push the economy into a brutal recession.
And it's worth just observing, John, that a number of commentators expressed surprise that the bank only took the 0.25% route, because they were expecting a bigger move, especially after the Fed had just made the mega move that they'd done. So there was an express of, hang on a moment, this isn't quite what we expected. So once again, the Bank of England, we know, has hooked it.
Yes. The other point we should call out, Martin, is that the UK decision was a split decision, so 6-3. So 3 dissenting voices wanted 0.5 and 6 went with 0.25. So, so there are some hawks, there are some doves, and they'll be very interested. Now, the UK, the Bank of England have said they are willing to be more aggressive if conditions require them to be so. But, to be honest, with inflation at 9%, and that being forecast to go to 11%. I don't know what else do you need. What additional evidence does the Bank of England require in order to be more aggressive at this point? I don't know.
No, it's also worth saying, John, that of course the Bank of England is also sensitive to the fact that there's a big government debt, and of course as they put the rates up, the cost of government debt goes up, and that's another negative factor. And there's a big debate going on in the UK as to whether the Bank of England is truly independent of Treasury or not. I think that's another factor that may have actually influenced the path as well.
Indeed. Now, when we turn our attention to Friday morning, Australian time, now in the last couple of shows we said that the Bank of Japan was not up for the fight in terms of inflation. They don't think it's a big deal, and that's why the Japanese yen has been falling versus the US dollar and gold and other currencies. Well, the Bank of Japan met on Friday morning and basically did not change policy. So they were comfortable with having official interest rates at negative 0.1%. And they basically made no changes to the quantitative easing program and the yield curve control program as well. And so, again, we have the Bank of Japan stuck saying we're not going to do anything, and if inflation continues to go up, so be it.
Yeah, and once again, commentators said, "Oh, well, that's weird because they're in a room of their own," and many of the bank analysts said they've got to do something. So it's very interesting that no, they're hanging still with the very low rates. It is fascinating to see just how diverse around the world things are. Because of course China is wrestling with rates and cutting rates and trying to get their economy going. You've got Japan with their low rates, and Switzerland. What about Switzerland?
Well, yes. So obviously we had Switzerland. I mean, they raised interest rates by 0.5%, but it was still negative. So they had an official interest rate of negative 0.75%, and they took it to negative 0.25%, and they foreshadowed that they may sell some of the central bank assets. Now, what are those assets? It's actually US. I mean, here's the fascinating thing between Switzerland and Japan. Japan holds a lot of US government bonds, and Switzerland holds a lot of US shares, US equities. And so they both, now, in the case of Switzerland, they have suggested that they may sell some of these shares. And if that was to happen, that's going to further push a lot of these big companies' share prices down through the floor. Yep. And that's going to have huge impacts in the United States. Now, in the case of Japan, now, traditional economic theory would suggest that if you want to stabilize the currency, you would tighten monetary policy. So you'd stop QE, you would raise interest rates. But the Japanese do actually have another short-term measure that they may wish to deploy, and that is they hold a lot of US government bonds. And so what they could potentially do is sell those bonds on the market, get US dollars, and then sell those dollars and buy back the yen to keep the yen, the value of the yen up to a particular level. So, and they hold, I think they're either number 2 or number 3 in terms of in terms of foreign governments that hold US government bonds. So they have a lot of bandwidth to sell a lot of US government debt and stabilize the yen. So I mean, who knows how long the process will go for, but obviously if they dump these treasuries, what is that going to do to US bonds? It's going to push down the price of the bond, push up the interest rate, and that's going to drive the interest costs of the US government, which will create new financial headaches for both Congress and the US Federal Reserve. So that could be a consequence of this whole situation unraveling, that Japan and Switzerland may put additional economic pressure on US financial markets. Now, we get into perhaps the most important aspect of the show, Martin, which is to talk about the US Federal Reserve. So we obviously saw last week with a massive increase of 0.75%, the largest since 1994. And it's only been 48 hours since that decision, and we've already seen capitulation in terms of the Americans in their fight against inflation. Now, I think you said to me off camera that the US Federal Reserve released a paper in which they were very explicit in saying we are going to fight inflation no matter what. But when you actually listen to what officials are saying, including the chairman, they are saying something very different. So let's put slide 10 on the screen. So in the last 48 hours, Chairman Jerome Powell gave a speech about the international role of the dollar. He actually had this to say, quote, The Federal Reserve's strong commitment to our price stability mandate contributes to the widespread confidence in the dollar as a store of value. To that end, my colleagues and I are acutely focused on returning inflation to our 2% objective. Meeting our dual mandate also depends on maintaining financial stability. The Fed's commitment to both our dual mandate and financial stability encourages the international community to hold and use dollars. Now, how is this capitulation? It's financial stability, because when you have this massive debt bubble and when you raise interest rates, you are going to see liquidity problems and credit problems, and then you're going to start to see defaults. And we're already starting to see some of those cracks occurring. And then once those cracks start to occur in the debt bubble, that's when the economy is going to go into recession. And that recession will, again, kind of like with crypto, the US economy will feed on itself, that negativity. And then you're going to have issues with financial stability. And when you get close to a credit risk event or a liquidity risk event, that's when they will have to, formally stop raising rates and saying, well, we have to reverse course, because otherwise we could have a financial crisis. So given that they've said that fighting off inflation is in effect contingent on financial stability, that is the surrender. Because if you're serious about fighting inflation, you've got to have a financial crisis, you've got to have a depression, you've got to pop the bubble and just clean the system out. And the chairman's basically saying, we're not willing to do that, and that is surrender.
Yeah. So once again, what we're seeing is this contention between inflation on one hand and financial stability and liquidity on the other hand. And whatever they might say, it does look as though they're also conscious of the fact that things could break. And so that question of the Fed put and when the Fed put might come back and how they take rates forward is much more complex than just saying, yeah, we'll fight inflation at all costs. That's not true.
Exactly. And so let's actually put slide 11 on the screen. So this actually came out this morning. So we actually have Federal Reserve member Waller saying that even in a typical recession, there's a decent chance the Fed will cut policy rate to zero and buy bonds. So basically they're saying now that if we're going to fight inflation while the economy is growing, but once we go to recession, which could be this quarter, given that the Atlanta Fed has projected economic growth to be zero, and they had the first quarter at -1.5, they said once we go to recession, we're going back to what we know will keep the system in check. And so whether it's the chairman, whether it's other members of the FOMC, it is surrender every day here, and there is no strong, serious commitment to taking this all the way.
Yep. And that presumably could actually take us to the point where you have to take rates negative, because they've run out of runway pretty much in positive land, right? And remember, we discussed in a few shows ago that regulators around the world are worrying about how to get negative rates to stick.
Yes, including APRA.
Including APRA. Those questions should be in the back of people's minds, right? Although rates look as though they're rising at the moment, we could see negative rates way sooner than anybody expects.
Exactly. Now, just to give our viewers a couple of examples of how the actions of the US Federal Reserve is starting to crack the US economy, let's put slide 12 on the screen, Martin. So this comes from a macroeconomic commentator from New York. And they're basically showing that yields on American junk bonds has basically doubled in the last 6 months. And we're getting to levels where you're going to see downgrades and potential corporate defaults. And one of the key points that we've said in previous shows over the last few years is that US corporate debt is a huge problem. Yep. And right throughout the entire corporate sector, particularly listed and in terms of unlisted companies, one tactic, particularly for listed companies that the Americans have done, is they have assumed vast amounts of debt and use that debt to buy back their stock to drive up the price. And they did that because it was a more effective way to drive the share price up in the short term, assuming interest rates were going to be low. Well, if junk bonds and other interest rates are going up, the interest costs for corporates are going to be huge. And you're going to start to see a number of companies starting to go into financial difficulty, bankruptcy, insolvency, etc. So the financial system in America can handle a whole bunch of small companies going bust, but when too many of them go bust, and that starts to feed into some of the big companies, and if they get into financial trouble, well, that's going to then impact the banks. And then you have the whole question of financial stability. And just like we showed with the quote from Cole Bass, this is happening at such a rapid rate that we're not talking 9-12 months down the track. We could be talking 9 to 12 weeks in terms of starting to see medium-sized to large corporates in America declaring their hand and saying we have some really big financial problems.
It's worth just noting, John, that the US markets are closed on Monday. So I'll be watching very closely on Tuesday because I think there is going to be a considerable possibility of significant falls on Tuesday. And I just remind people that actually September is often the month in the year when if things go bad, they go bad in September. So I'm wondering whether all of those things point to a rather bumpy in a couple of months and then a real crunch in September, because the speed of this is huge, right? It's just going so fast. And I'm not sure that central banks will be able to even see or monitor the actions of what they've done, right? Because it takes months normally for interest rates to percolate through the economy. They haven't got time.
Precisely. And just to highlight that, if we put slide 13 on the screen, Martin, is only in the last few months have we seen mortgage rates look over a 30-year cycle in the US effectively double. And in the last few days, it got above 6%, and it's around 6.28%. And so a lot of households, and again, so just in our last show, we talked about how US households are holding $16 trillion worth of debt. A lot of that debt, particularly mortgages, were borrowed around 3.5%, and now they're at 6.5%. So their mortgage rates are moving at a more rapid rate than some of our mortgage rates here in Australia, and that's going to have huge implications for the household sector in America.
Well, just to be clear, though, of course, many people have got fixed rates, and that means that they don't get the same immediate feedback. It's not like the variable rates here. It's new loans being written at that much higher rate. But nevertheless, the speculation now is that the housing market in the US is already coming off its highs, and in some cases prices are lower. So people are suggesting that actually the housing sector will also be going into some sort of recessionary territory quite soon. Another negative indicator.
Yes. Now, in one of our previous shows, just to highlight this point, Martin, is you've talked about bottom feeders coming into the property market and swooping a lot of stuff up. So a lot of hedge funds in America bought a lot of cheap property after the GFC, and they used leverage to buy a lot of their housing. So if the housing goes down for these hedge funds and they're holding a lot of debt, well, they're going to have some capital, or they're going to have some credit issues that they will have to deal with. And it's going to be very fascinating to see whether these hedge funds will hold onto their property portfolios or whether they'll dump them. Otherwise, if house prices in America continue to fall, some of these hedge funds may go belly up.
Yeah, and that's another very important factor, because you should say when they went into these transactions, debt was really, really cheap. But now debt is getting much more expensive. At the same time that the value of property is falling, suddenly their proposition may not look anything like as good. And again, another potential financial stability issue on the horizon.
Okay, Martin, so just to bring this conversation to a close, we are seeing the most rapid unwinding of this bubble in the course of economic history. And so this is causing all sorts of liquidity and credit problems, particularly in terms of the crypto market. Now, this is scaring policymakers because of what the implications are for the financial system and financial stability. And so even though some of these central banks are giving a very positive upfront, bravado, we're going to fight inflation, my view is that we've seen, in their own little subtle way, a complete capitulation to inflation. And so while some central banks like Japan, the European Union, and the Bank of England have effectively played their hand, it will take a bit of extra time for, say, Australia, New Zealand, and the United States to fully indicate transparently to the public that they're not really up for the fight. But let me assure our viewers that when push comes to shove, they're not going to collapse the bubble because none of them believe that they don't have the political courage to do so, but they also don't believe that it's the right thing to do. I think a lot of these people, and this is a conversation I've had with people in federal parliament, some people believe that inflation is a lesser evil than mass unemployment. And unfortunately, I think as we see throughout economic history, once inflation starts, it doesn't stop. Whereas if you go into a depression, depressions don't last forever. You can actually recover quickly from a depression. And I would revert back to some of our previous shows about the depression that happened in 1921 in the United States, the Forgotten Depression. So you can go through a depression and come out within 12 to 18 months and have a robust economy, even though that 12 to 18 months will be horrendous for millions of people. But you can recover from a depression. You can't really recover from runaway inflation because ultimately the currency collapses, and then you've got to reestablish the currency. But that obviously has long-lasting effects in terms of the population. So there's a lot that our audience needs to get on top of, and inflation doesn't just impact mortgage holders. And obviously, the last couple of weeks in Australia, there's been a lot of commentary about the household sector. Inflation affects everyone, and people need to buckle up and get prepared for what does it mean to live in a high inflation economy.
And John, it's worth, I think, reflecting on central banks in 2008, through the global financial crisis, started to do stuff, never really fixed the problem, tried to keep things going and going and going and going and going, right? And here we are, many years later, still with the same issues. They have not proven their mettle to really take those serious decisions to solve issues. It's about trying to keep everything just going along. And what you're saying is they're going to do the same again.
Exactly.
Thanks for your time today, John. Very important conversation. And I'm sure we'll be back in the studio very soon.
Indeed.
Martin North, John Adams, in the interest of the people. We'll see you next time.